Well, good afternoon, good morning, and good evening, everybody. My name's Zara Ritchie. I'm the Global Head of Transfer Pricing with BDO, based in Melbourne, Australia. I'd like to introduce my panel to you. If you look at your slide in front of you, the presenters today. So firstly, Paul Sutton, who is the founder and partner with LCN Legal. Patrick O'Sullivan from MyNet Phone or MNF Group here in Australia, Group Tax Manager. Joel Phillips, Transfer Pricing Partner with BDO based in Sydney. So let's move through the slides, and I'm just going to provide a little bit of an introduction to what we're going to cover today. So if we can move to the next slide. So we are intending to provide a very practical insight on today's webinar, and if you have any questions, please do log them as we speak. Please don't wait until the end. We're very happy to take questions as we go and try to address them. Now, we do have a global audience, so there's a large number of people on the webinar and from all parts of the world. So hopefully we'll try and get to as many questions as we can, but if we don't get to your question, we will try to respond separately after the webinar. I'm going to start with some scene setting in a moment, and then we'll launch into a full panel discussion, and we have got some polling questions along the way as well which we'll cover off. So you are muted, as I think you're probably aware, throughout this webinar, and there'll be some post-event communications that are shared with you after this, including the recording, which you're quite welcome to share with colleagues, and also some key messages. And if you have got any follow-up queries after the webinar, please feel free to reach out to any one of the panel members after today's session. So what are we going to cover? So practical TP insights and legal insights in relation to your legal agreements, and obviously the benefits and opportunities of having legal agreements in place. We'll be discussing those. If we can just go back a page on the slide. Sorry, I think we've got a little bit of a time difference between London and Melbourne, so we're bouncing around a little bit. My apologies. So we'll cover off benefits and opportunities, of course, of having agreements in place, pros and cons, tricks and traps, and I think we've got some quite interesting discussions and debates to have amongst the panel based on the experience and backgrounds of our different panel members. And of course, our focus is in the context of COVID-19. So what are the impacts that COVID-19 has or is having in relation to the transfer pricing environment, and how does that sort of connect with the agreements and policies that you have got in place, and what steps should you be taking as organisations in terms of managing your legal agreements in the context of COVID-19 and transfer pricing. So I guess if I just make some preliminary comments, I think the situation so far, everybody is impacted by COVID-19 in some way, shape or form, either personally or professionally or from a corporate or business perspective. Of course, the level of that impact varies on your circumstances, which country you're in our case in Australia at the moment, which state you're in. Some states are doing better than others. Of course, the industry and the stage at which COVID-19 is passing through your jurisdiction. Some countries are still at the very peak. Some countries seem to be coming out the other end and starting to sort of focus more positively on the future. I guess what we are doing is focusing on the environment across three phases. The first phase we would say is survival, like what do you need to do to survive and react to the impact of COVID-19. The second phase is how do you stay resilient? How do you ride the wave? How do you do as much as you can to stay operational, effective, above water as long as you can until we do start coming out the other end? And then that third phase, which is what we're all looking forward to, is when we all start to thrive again in whatever becomes the new normal in our post-COVID environment. And of course, it will be different. I think we all realise that already, that we're all changed forever across so many facets. So we'll have to readjust to what the future holds for us. So the situation so far, if we just flick to the next slide, I'd like to just give you the global sort of environment just as a scene setter, I guess, because I think many companies are right in the midst of some of these challenges. So there is, of course, a disruption to supply chains. There is a divergence or a variation in where companies are having to seek suppliers, whether it be raw material, where they're buying or selling goods, how they're buying and selling goods. There's obviously disruptions to borders, to transportation, to so many things that we take for granted in operating in business environments. You may have people that are stuck in particular locations or countries. I'm sure most people have got at least half, if not all, of their workforces working remotely, although some countries are now starting to go back into the office, but not in the same way that we have done before. Cash flow pressures is obviously the number one item that has hit many organisations, if not most organisations. And then, of course, flow on profit impact, is whether that's short term in the period that we're at now, or whether it's actually longer term, whether there will be complete disruptions in terms of how businesses operate or need to operate, and that will have maybe permanent upward or downward impacts on profitability. And finally, tax authority environment. I think in talking to our global colleagues, what we are seeing is that there is a level of empathy from the tax authorities around the world, which is a good thing. There's definitely government stimulus measures of varying types across the world, and that's a good thing. But of course, any investments that governments make now for the long term have to be funded. And we all know that multinationals have typically been a very strong focus area for tax authorities around the world, and we expect that that will continue. So we have a little bit of breathing space at the moment for all good reasons, as businesses are trying to survive and maintain their businesses throughout the COVID crisis. But there's no question that that will reverse at some point in time in the not too distant future, when tax authorities have to revert to their integrity measures and fund the generous stimulus measures and economic measures that they've afforded to their corporate taxpayers in their communities. So with that sort of background and context in mind, what we'd like to do is start with a couple of polling questions. So if we can perhaps go to our first polling question, and we would just like to use this as a bit of a scene setter. So to what extent do you have related party transactions that are supported by written legal agreements? So if I could ask the participants to respond, please, and we'll bring the results up in a moment. Okay, thanks, Gabby. Do we have any results that we can put up on the screen? Just pausing while we bring those results up. No, it looks like we don't have, oh, here we go, some results. Okay, so legal agreements, more than 60% of participants have legal agreements covering most of their transactions, and some have less than 50%. Okay, thank you. Let's move to the next polling question, please, Gabby. Those responses are probably not unexpected. So the next question is whether your legal agreements support your intercompany transactions and whether they've been prepared by a legal advisor or in-house. So please, if you could respond to this question, and we'll bring the results up in about 30 seconds. Do we have any results, Gabby? Okay, so there's probably an interesting statistic for you, Paul. So 50% prepared by in-house legal team, and 25% by another function in-house. So we'll come back to that. Thank you. And just a final polling question for now, if we can quickly flick that one up. Gabby? So this is a question around resources. Do you feel that you have sufficient resources to manage TP obligations and risks? And really, we're phrasing this question in the context of COVID-19 now. So if you could please respond. Let's bring the results up, Gabby, if we can, please. Okay, so it's reasonably split. 50% say no, 40% say yes. Yeah, it's probably not surprising, although I probably would have felt that that no would have been a little higher than 50% based on discussions that we're having with clients. But I guess that's good news for those 50% where you feel you do have sufficient resource to manage in the current environment. So that's good. Okay, that's the end of our poll. So we'll just revert to some discussions now amongst the panel. So I'd like to throw the first question to you, Paul, if I may, being the lawyer on the webinar, on the panel. So why do companies need written legal agreements for their intercompany transactions? And is it sufficient? And Gabby, we can remove the polling question from the screen if that's okay, please, so people can see the panel members. Great, thank you. So is it sufficient for companies just to have a transfer pricing policy in place or documentation? And yeah, what's the need for written legal agreements? If you could maybe kick off with that, with your comments.
Sure, thanks, Sarah. Yes, so from a transfer pricing perspective, legal agreements are a fundamental part of transfer pricing documentation. So as I'm sure many people know, under the OECD's TP guidelines, the guidelines say that master files must contain a list of important agreements relating to intangibles, and the local files must contain actual copies of intercompany agreements. More fundamentally, from a transfer pricing perspective, what legal agreements do is actually delineate the transaction, or rather they're the first step in a transfer pricing analysis of a transaction to describe it or delineate it. And that's for things like allocation of risk and reward between the parties. So that's from a transfer pricing perspective. I guess the critical thing that people should understand is clearly agreements are not just about transfer pricing. There are a number of other stakeholders and drivers for intercompany agreements, and that includes things like GST or VAT compliance and VAT analysis, customs duties, regulatory compliance, data protection, asset protection, IP protection, and so on. So it's a range of stakeholders which require intercompany agreements as the hook, if you like, for the internal governance. And then finally, and maybe this is a point we'll come to later, is from the perspective of individual legal duties of directors within specific entities within the group, the intercompany agreements are actually a key way for directors to demonstrate that they're actually complying with their fiduciary duties to look after that particular entity and its creditors, because without that, it's very difficult for someone to say, yes, I have complied with my duties and considered the interests of that entity. So that's really it in a nutshell.
Thanks for that, Paul. Patrick, from a corporate perspective, obviously you've been in a corporate role for a long time. What's your response to that? Do you think that it's important to have legal agreements? Are you seeing sort of a mood or a change from an internal perspective in terms of the requirements as well?
Yeah, no, I definitely think it's important to have legal agreements. I suppose I've been working in tax now for maybe 12, 13 years. First half of my career was on the in-house side with a Big Four, and now I'm in-house. And I've really noticed a big change over that period of time. I think there's been a move in emphasis towards transfer pricing from tax authorities, and it's also become very topical globally. And what that's done is means that you really have to have strong transfer pricing policy in place. And as Paul rightfully mentioned, it kind of has to be underpinned by legal documents. And one of the ways I always look at this is tax in general is very black and white. You can check the tax treatments, whereas transfer pricing is grey. It's a grey area. You can build an argument, build a case around different transfer pricing policies, but a legal document is a black and white document, and you can have that certainty within a company. So I suppose I definitely think it's important to have legal agreements is the first point I'd make. As concerns the attitude of companies, I think most CFOs now would be a little concerned about transfer pricing. I thought one of the poll results was very interesting, if I might mention it now, that 47% said they didn't have the appropriate resources to deal with the transfer pricing workload, basically. And it's interesting because the majority of people on this webinar are going to be tax professionals, and I'd wonder if that number would be as high in CFOs, because I think there's a distinction between a CFO thinking, I have a tax person, I have a group tax manager, a head of tax, so I'm okay, whereas transfer pricing is a slightly different area. And I think historically large multinational companies didn't have one transfer pricing company in their organization who would basically own all those legal agreements, whereas I think that's where we're moving to for larger multinationals. And it comes back to, for those companies, they don't want to take on the risk. They have their governance is too important to them, so they're building a risk governance framework for their company. They need legal agreements in place that protect them. And as Paul said, it links back in, it's not just transfer pricing, it's also treasury and a raft of other areas, financial control and standards, that you have to basically have a robust governance structure in place. So overall, I would definitely say we need them.
Thanks for that, Patrick. There's some good points raised, and we'll come back maybe and talk a little bit more about a couple of the points that you picked up, particularly around governance. Joel, what are you seeing in practice? Are you seeing more agreements? Are you seeing less agreements? Are you seeing a greater response to the need for agreements? Practitioner's point of view.
Yeah, absolutely. So I think we are seeing a strong response for legal agreements. I think most people are aware of the requirements, and some of the points that Paul mentioned, some of the obvious areas, and we'll dig into those in later detail. But one thing I've really noticed is the attitude has changed, and it's changed a lot. So if I think back over my time in tax, and I've spent over 20 years now in tax or transfer pricing, both in the advisory and in the corporate sector. It has changed dramatically. I think if you go back, in the pre-2013 years, especially before the GFC and the initiation of BEPS, the compliance, if you like, around having transfer pricing legal agreements, but the wider tax governance in general was quite poor, to be quite honest. Quite difficult to get the budgeting, if you like, from your CFO, because the costs of tax compliance are above the line, whereas the actual tax expense is below the line. It's always a never-ending argument. And it was very difficult, and it was outside this standard, financial risk analysis. I think what we've seen is that this transfer pricing has become a political agenda, and as a result of that, following BEPS, we are seeing very strict compliance both by tax authorities and by corporates in general. And it certainly is one of the most important documents, and one of the first documents requested by tax authorities as a result when they actually do have some kind of scrutiny, whether it be an audit or something else. So yes, we're seeing a lot of compliance. I think as per normal, the compliance is probably better with the larger multinationals, and it's largely aligned with, I guess, the allocation of resources from tax authorities, to be quite honest.
And Joel, do you see any benefit in having legal agreements where you do have a dispute with the tax authorities? Is there a level of expectation from tax authorities, and how does it influence, I guess, their behaviour or their investment in reviewing a company?
Yeah, sure. So there's a big advantage in having legal agreements. I think, as once again, as Paul mentioned around the master file and the local file, there's a clear expectation and focus from the ATO as well as other tax authorities around the world that legal agreements are in place. And if you don't have them, then your risk profile will increase significantly. And we've seen that, with respect to the Australian-specific local file obligation, so the compliance obligation, and you have to disclose there where for all your international related party transactions what level of documentation, and particularly in what level of legal agreements you have in place for each of those transactions. And if you don't have those, then your risk profile goes up. But more importantly, if you haven't got a legal agreement in place, then you haven't got a contemporaneous position showing the intention of the parties. And without that, you're not putting your best foot forward. It is the document that the OECD looks at first and says that you need to look at your legal agreement. Of course, if it doesn't align to substance, then you have our local reconstruction provisions in Australia, and of course the OECD allows a substance over form argument, but it is the starting point. And if you're in an audit and you don't have the position available to show your starting point, then there's a very different negotiation or discussion, if you like, with the tax authority. If you've got a legal agreement, they've got to prove that it's not appropriate. If you don't have a legal agreement, then they will have their own assumptions, and you have to prove that they're not correct if they're not correct. So it's a very large advantage to show a contemporaneous positioning with respect to the intention of the two parties in relation to the arrangements in place.
Thanks, Joel. Can I just pick up on another point before I move to perhaps a more controversial question? But I think a couple of people, well, actually all three of you have touched on governance. I think probably in slightly different contexts, but you've all touched on governance. We see that the tax governance frameworks, other governance frameworks, corporate governance frameworks, tax authority expectations, regulatory expectations. We're certainly seeing a step up on that. In Australia, I know that there is in the UK and many parts of the world, not all parts of the world, but it's probably only a matter of time before other tax authorities pick up on, I guess, the importance and the benefit of a strong governance framework. Patrick, can I maybe come back to you, because within a corporate environment, what are your thoughts and or experience in terms of how a strong governance framework, tax governance framework, can support you, particularly in dealing with tax authorities?
Yeah, absolutely. So I had a detailed tax review with the ATO before, and the focus of the review became very much transfer pricing. And while everything was perfectly in place and transfer pricing was fine, because we didn't have a governance structure that was within the recommendations of the ATO, we had a governance structure, but it wasn't exactly what was prescribed by the ATO in their guidance. They weren't happy about that. So it is something that I feel that tax authorities, particularly the ATO, are really getting harder on. They expect to see a really, really robust governance structure in place. They expect to see tax discussed at board level as well. They expect your governance structure to be testable from an internal control point of view, and that that operations are following that structure. So I think it's a very good point, Sarah, because it brings it back to the legal agreements and the transfer pricing agreements. They're just one piece of a larger tax governance structure that would cover all areas of tax across the company, and then that tax governance structure is a smaller piece of an overall internal control management structure for the company. So I think all these areas are becoming more topical as we go on, but certainly tax authorities are not turning a blind eye to poor governance. I think if your governance isn't up to scratch, they're much likelier to go harder on you in a review or audit scenario.
It's so true. We've done a justified trust roadshow with the Australian Taxation Authority, with the relevant people that are running the program, and it's very clear. We talked about risk profiling of clients earlier, but the ATO absolutely allocate their resources based on the governance, the perceived governance, if you like, of the taxpayer, and that's very clear within the justified trust program. I mean, there's a set structured process that they run through there, and they do look at both the government structure with respect to the tax compliance to ensure that it's in place and it's effective. And in simple terms, they've said they're not going away until it is. So if you don't have a strong government structure in place, then they are coming back, and it's a very clear message. And to your point, yeah, sorry, yeah.
Joel, I think you made a very good point when you said the perceived governance structure needs to be in place. And it is a perception. I think if a tax authority sees no legal documents in place, they feel, okay, this is a disorganized company. Even if your transfer pricing is perfect, they might feel this is a disorganized company. And then the review gets off on that footing. If they see the structure in place, they realize, okay, the first thing they start thinking is we're not going to find much here because these guys have everything squeaky clean.
Yeah, spot on.
Absolutely. And I think something that I grew up with many years ago, Patrick, is this concept of perception is reality, or perception becomes reality. So, perceptions are important. So, yeah, it's a good point. Thank you. And I guess it aligns with what you were saying, Paul, in terms of, because a legal agreement is a foundation for agreements between, parties, terms, conditions, etc., and it feeds into the governance framework, but it also serves so many other purposes, as I think you started with at the outset. So I think we're all, we being on the panel, we're all in agreement. There's a lot of advantages and reasons for why you would have a legal agreement in place. So let me throw a different question to you, and perhaps I'll start with you, Paul. Can you think of any advantages or reasons why you would not have a legal agreement?
It's good, really good question. I think in the past that there was this idea of maintaining flexibility, and so that there was a view, well, we shouldn't nail ourselves down. We should be able to adjust our position at the year-end points, and that was reflected not just in an absence of agreement, but also agreements with incredibly vague terms. So agreement to agree type clauses on pricing and so on. So, and I would say that kind of view was maybe more prevalent 10 years ago, but certainly now I think in line with the sort of the general understanding and convergence of governance, tax governance, corporate governance, and all the other stakeholders, there's the realization, which is you can't have your cake and eat it. You can't on the one hand say, well, I'm just going to keep things flexible, and on the other hand, put together a very specific transfer pricing policy that says, well, these risks have been allocated to this entity and away from that entity, and there's a guaranteed return for this entity. It just doesn't stack up. So I think think times have changed.
And I think just to come in there on Paul's point, it comes down to that relationship as well between head of tax and CFO in companies, in that the CFO may have had the previous impression that it's better not to tie yourself down, as Paul referred to being around a lot 10 years ago, but it's the role of the head of tax in today's environment to advise the CFO of the risks of maintaining that position. At the end of the day, the CFO signs a tax return probably, or a director signs a tax return. So there is a duty of care on a good head of tax to advise of these issues now. Because for me, if you're not advising your superiors in the company that they need these legal agreements, they need transfer pricing bedded in, particularly for a multinational company, if you're not giving that advice up the chain of command, you're probably not doing your job. So I think the role as well of a head of tax has kind of become broader because of the importance of transfer pricing and legal agreements on the whole.
Thanks,
One
Patrick.
One thing I
mentioned.
Thanks, sorry. One thing I'd mention, I'm just looking at your comments, Paul, with respect to legal agreements. And once upon a time, there was a stronger argument amongst well, I wouldn't call it a stronger argument. There was a stronger perception once again that agreements weren't favourable. I don't think anyone could argue that legal agreements aren't favourable. It's absolutely imperative. Pardon me. Imperative to have a well-documented legal agreement to have the taxpayer's position with respect to the functions, assets, and risks allocation of the parties with respect to the structure in place, and that then builds the starting point, like we said, for the transfer pricing analysis. One point I just raised, and it was with respect to an audit that we had between Singapore and Malaysia, actually, and it was a limited risk distributorship, and the legal agreement had a set pricing point, so it was a set percentage, which was an EBITDA sales ratio. And what happened there is that percentage was obviously within the interquartile range that was identified in the transfer pricing documentation. But the Malaysian government actually made an assessment between the pricing point and the top of the interquartile range in order to get us as much out of that assessment as possible. Now, obviously, we're aware that under OECD guidelines, anything within the interquartile range is considered arm's length. So you do have to be careful on certain terms. And I've seen a lot of agreements structured with very detailed analysis around allocation of functions, assets, and risks. But they might say that the pricing will be an EBITDA sales ratio that will be determined on an arm's length basis, for example, between the parties on a year-by-year basis. And that allows movement for comparables on a year-by-year basis as well.
Thanks, Joel. We might talk a little bit later about the construct of a good agreement and a not so good agreement without giving too much of Paul's intellectual property away, because there is a difference between a good agreement, a well-drafted agreement, and a poorly drafted agreement. So I think we will come back to that, remind me. But right now, I guess I wanted to just pick up in line with the sort of theme that we were talking about. So legal agreements, I think we all agree, they play an important role. And we all understand the concept, and you raised it a couple of times, Joel, legal form and substance over form. And so I guess the question that many people have is, you've got your agreement in place, we all agree that's the right thing to do, but then perhaps in practice what's actually happening in business is not quite the same as what is in your agreement. So again, kicking off with you, Paul, if I may, what do you do in that situation if the legal agreements that are reflecting or are supposed to be reflecting the intercompany transactions between companies don't align with what's happening in practice? What should one do? And maybe it's a chicken and an egg, but what should one do?
Yeah, so this is really the nub of the challenge for all of us, isn't it? Is to design transfer pricing policies and corporate governance policies in advance, in anticipation of what the business might do, and it's going to be impossible to get it completely right. From a legal perspective, in terms of design of agreements, I guess the key point that I would say is you should think of the agreements as framework agreements. In other words, what we don't want to do is create a cottage industry of having to update the agreements each time a new product or something is launched within the group. So what you're trying to do is create a framework for each key transaction type that delineates the transaction in terms of describing allocation of risks, functions, and reward between the parties, but as far as possible is future-proof, is capable of operating in a number of different environments. In reality, there will always be a need to catch up and to adjust, and I guess we'll come on to this later in the discussion, particularly within COVID, in terms of how to approach and adapt transfer pricing policies and agreements in response to different circumstances.
Thanks for that. And maybe we will come back to my question about good and bad agreements, because you did sort of just mention, Paul, or you gave some hints anyway. Because you're right, in practice, things change in business. Whether it's alignment between substance and form or not, things are going to change in business. So you need to have a pragmatic approach in terms of being able to make those changes. So, use of appendices or attachments or ways of having your framework agreement versus what actually goes into an appendix or something that can be adjusted more easily than actually having to recraft or amend the agreement each time. Joel, if I can turn to you with that sort of thought in mind, what have you seen in terms of this discrepancy between the agreement and what's actually happening in practice, and what's some of the practical advice that you're giving to clients and how they deal with that?
Yeah, and I think the best way to start that is if your substance doesn't equal your form. So if your substance isn't aligned with your legal agreements, well, you've got an inherent problem because then you have room for the reconstruction provisions or for the tax authorities effectively to apply those and then come in and make an assessment. And you don't want to be in that position. I think from experience with audits or advanced pricing agreements, even in that scenario, what you will find is that, especially with the less sophisticated tax authorities, that they will tend to cherry pick. So if the benefit to them is to look at the legal agreement in that scenario, they'll ignore the form, the substance, and then they'll take their assessment on that basis. With that disparity, however, if it's in their interest to look at the substance and then that provides a better outcome, typically that is the starting point for an audit. We would hope in the sophisticated tax authorities that it should always come back to substance and the correct substance, but in practice, in some tax authorities, that's not the case. So I think it's very important to understand what your substance is, and that can be difficult. There are exceptions, I guess, and they're rare, and I don't really want to use the word exception actually, however, but there are scenarios, and a typical one is where you actually have had a restructure, and you put the restructure in place, you sign the legal agreements on day one, but there is a following cultural shift required to ensure that maybe it's a centralization for resources, for example, and a shift of accountabilities. It can take some time to actually enact that restructure. So there can be a period where, even though your legal agreement is to be the substance, it may not be there yet, and that can always be a sticky point, or a point that comes under scrutiny in tax authorities. Once again, an APA that we had with Singapore and Japan, that position came up, and the substance didn't equal the form, but it got there eventually. So there was a sliding pricing change that was built into the negotiation. So it is very important to ensure that if you do have one of these restructures, your cultural shift and your actual ways of working change in alignment with your legal form.
From an in-house perspective, what we'd normally look at is, when we do our annual review of our transfer pricing documentation and our intercompany agreements, if we found substance had moved and the agreement was no longer, I suppose, appropriate, we would look to realign the agreements and draft a new agreement. But I think it's an interesting question, because I think a lot of agreements in companies have been drafted in the last decade as this has become more topical. Now, obviously, companies that have had restructures may have redrafted their documentation at that point of view. But now with COVID-19, there may be a lot of structures changing within companies. There may be, for a lot of companies, the first time they'll have to redraft their intercompany agreements and bring them in line with the substance of the new substance of what their business is doing. So to bring it back to, I suppose, the whole reason we're discussing today, the importance of legal agreements in the context of COVID, I think it is very important with COVID that you look at that substance and form question as concerns your legal agreements, and look to address it with a redraft. I think it would be appropriate to be reviewing your documents every year as you do the transfer pricing. I'm not sure what Joel would think.
Yeah, absolutely. And I think if you don't look at your transfer pricing documents every year to determine whether your functionality has shifted, then you can't really say that your transfer pricing documents are fit for purpose. So, one thing I learned, like I said, I've been an advisory and I've been in a corporate, I've been on both sides of the fence. And one thing I've certainly learned through that period is that what was the status quo last year is very likely not to be the status quo the next year, or certainly 3 to 5 years down the track. So substance does shift. It shifts quite quickly. So without analysing it, then you don't have that comfort, and especially the public officer, for example, cannot effectively sign off that their transfer pricing documentation has been appropriately assessed if they haven't identified that the substance remains correct.
I think that this is the heart of it, isn't it? I mean, and to Patrick's point, COVID is highlighting the importance of well-constructed agreements with some flexibility, perhaps, but flexibility within the context of how transfer pricing guidelines should be applied, not flexibility in terms of breaching clauses or terms and conditions. So I think it's different. I guess the other observation I would make is that in many countries, the burden of proof rests with the taxpayer, not with tax authorities. And so, we can sit here feeling very comfortable about our position, about our agreement, about our substance, about our transfer pricing policy, whatever it might be. But at the end of the day, when you're under review by a tax authority, it's usually your responsibility as the taxpayer to defend your position rather than a tax authority to defend their own position. And there are some countries where that burden of proof changes, through the course of that dispute, but that is an important starting position for us to remember. Picking up on COVID-19 and what is, I suppose, what are some of the challenges in the context of COVID-19? Paul, what are you seeing from a legal perspective? Because there's a lot of debates around should you make adjustments to your transfer pricing policy? So is it a policy change? To Patrick's point, is there a restructured change within the business that's fundamentally changing something within the business? Or are we talking about a change in the range, in terms of the arm's length range or arm's length outcome that we're talking about that fits within the policy and fits within the agreement? Or is it all of the above? So any comments that you could make in terms of what you've been seeing in practice in the 4 months since many countries have fallen into the COVID-19 crisis?
Yeah, sure. So from my perspective, I would definitely say it's all of the above, and it's in line with our mantra, which is that intercompany agreements need to be looked at from a holistic perspective, and the transfer pricing policies and the governance and the funding and the risk management needs to work hand in hand. So there are countless multinational groups who are currently revising their intercompany pricing and therefore revising or looking at revising their intercompany agreements. Perhaps if I could just give viewers a few fundamental principles from a legal perspective that they should bear in mind in this process. The first point is the golden rule from a legal perspective is look at the arrangements from the perspective of each participating legal entity. So it needs to make sense commercially from the perspective of each legal entity. And that's similar to the transfer pricing concept of options realistically available to the party. So it's just that legal entity perspective. So that's number one. Number two is obviously you're going to be looking at the existing terms which are in place. And in some cases, the drafting of the clauses may be sufficient to give you that flexibility. For example, cost plus arrangements. Well, how is cost defined, and where does that place additional COVID-related costs? Is that something that is passed through in that arrangement, or does it remain with the service provider? So obviously you'll be looking at those specific terms. Point three is if changes to the agreement are needed, then you'll be looking at the specific termination provisions and perhaps force majeure clauses in relation to those existing agreements. Although I would say that despite the number of articles that are out there within the transfer pricing world saying look at your force majeure clauses, they're actually less relevant than you might think, because generally speaking, force majeure clauses don't excuse performance of payment obligations, and they generally don't provide a get out of jail free card in terms of we don't like the pricing anymore. That's not what force majeure clauses do. So look at the clauses that are there and whether they give a reasonable basis for renegotiating. And then finally, even if there aren't any specific exit clauses that you can rely on or termination clauses, then of course, just like any other commercial relationship, it's open to the parties to renegotiate it. And like any implementation or adjustment of transfer pricing implementation, again, the process, the governance for that change needs to be properly managed. So it can't be just the tax function saying to directors, please sign here. It needs to be an informed consent, which generally speaking means some kind of briefing note saying, this is the situation, this is why we're doing it, this is the impact for these categories of participating entities, and if you have any questions, let us know, kind of thing. So those are the key planks, I would say.
And Paul, that all links very tightly, I think, with transfer pricing and economic analysis and documentation that's required to support any adjustments to the transfer pricing in any case. So I think it just puts the story together. Patrick, from a corporate perspective, what are your observations in terms of amending legal agreements and the challenges under COVID-19 that you're dealing with now? Are you seeing that your agreements are reasonably well constructed so that they give you the flexibility that you need to adjust your transfer prices under your existing policy that's reflected in the agreements, or are you seeing gaps that need to be addressed?
Yeah, I suppose I'm in a lucky position that I only recently redrafted the legal agreements for our company, and they were drafted kind of in the context of what we've been saying in this discussion, broad in the right areas, but correctly approved by our in-house legal team, and there was also some involvement from external legal advisors as well. So we had really getting a bit of feedback there. I'm not sure where it's coming from. Yeah, so to answer your question, I'm seeing it as a more important area.
Thank you. And Joel, what are your observations? There is some feedback. I think perhaps we all need to mute. What are your comments, experience, Joel?
Yeah, I think with respect to legal agreements, the most important time for legal agreements is when you're preparing them, because unfortunately when the issue arises, the risk that will arise will be many years down the track. So, for example, it's quite easy to prepare a legal agreement, but it's quite difficult to prepare one that's going to cover all your risks. And you know, a great example is you put a legal agreement in place, it's got a certain term, and this is a real life example from an audit again. There was a transfer of, there may be a few years later, a transfer of a asset or a restructure under a Chapter 9 of the OECD. So maybe it's a revenue shift, for example. When looking out what the exit charge or what the CGT event would be in Australia, in this particular audit, they looked at the term of the agreement and then what that revenue stream would be under that term in order to get to the net present value, the term of the net present value. So you've got to be very careful around how you actually create the rights within the agreements at the time. And that risk can only be managed at the time you write the agreement. I found it quite interesting in our panel session. So there was, I think it was 25% of respondents actually said that the non-legal team, so whether it be an external or whether it be internal, but people outside the legal team actually created those legal agreements. And okay, if they're in tax, they've got a better chance to understand the risk, but it's certainly, in my experience, a strong correlation between tax and legal, whether outsourced or insourced, to manage these.
Just to come in there, Joel, I would agree with that. I really feel you need a legal advisor, be it in-house or external, to be involved in this process. I think tax people are great. They may be solicitors as well as tax people, but their day-to-day job is tax. So, and finance people probably aren't solicitors. So I would think you need legal advice, be it internal or external. And I would come back to one point Paul touched on, just kind of the cross-functional nature of getting these things signed off, in that you have to mention and say, this is why we're doing these documents, this is what you're signing, as opposed to just putting it in front of a CFO and getting an X on the document. And I think that's really important, because I think this discussion isn't really just a tax discussion. It's transfer pricing discussion, yes, but it's also much broader than that, because it touches on so many areas, from treasury to financial control to tax to legal. And I think you need to align them all to get a good, robust legal agreement in place. So I think it's important that the tax function isn't doing these documents on its own and reviewing them themselves and thinking they're right, because I think you need to involve all stakeholders.
I'd like to add to that, Patrick. I think as advisors, we often get asked, can we assist with drafting an agreement, or can you just, share some suggested terms and conditions, and then we'll just prepare it in-house and, execute it, and off we go. And, I've always been reluctant to do that, at least not without the client, the company, getting some sort of legal sign-off as well. So we can certainly give guidance and give a steer in terms of the types of things that should be included in the agreement in the context of transfer pricing, not from a legal perspective. I'm not a lawyer, but what I would say is in drafting in conjunction with legal advisors and with Paul, we've done a few agreements together. My observation is that it's a little bit like tax. You could be a tax advisor but not have a lot of experience in transfer pricing. Therefore, you might get, a reasonably complicated question in transfer pricing that as a tax advisor you can't answer. I couldn't answer a question about GST, for example, or an R&D tax concession, but I can answer most questions about transfer pricing. And I think it's the same with legal agreements. And in my experience, using some lawyers, including in-house lawyers, in drafting agreements that are drafted to capture what's important from a transfer pricing perspective, with the intent that they're going to be relied on by a tax authority at some point in the future. I think it's really important to very carefully select your external legal advisor and test whether they've got experience in drafting transfer pricing related agreements. You know, we had one example with a client maybe a year or so ago, and it's a large organization, and it is a complex transfer pricing policy that we have in place, and there's a profit split involved. And that particular organization wanted to use their normal commercial lawyers. So we provided a lot of guidance to the normal commercial lawyers. They came up with an agreement, and it was not well drafted at all. It was very poorly drafted. And then we took that to an experienced legal advisor, happened to be Paul actually, and what Paul turned around was completely different and had good practical advice and insights on why it needed to be crafted a particular way. So I would encourage you know, our participants on this webinar to be really clear on the experience of the in-house or the legal person that they're speaking to make sure that they get into their agreements what they actually need to be in those agreements.
And I've actually had a similar experience in that I got transfer pricing advice of two large accounting firms when I was in a previous company, and the advice differed quite significantly. So I would bring it back to the value of a strong transfer pricing advisor that you trust. And from an in-house perspective, I have tax advisors in different countries to do compliance, etc., GST advisors. For me, my most important advisor is a transfer pricing advisor because I'm a tax generalist. And this comes back to the point Sarah made about she's a transfer pricing lady. She knows that very well. But most in-house tax managers are generalists. So for me, the transfer pricing advisor is very important, and as well picking the right one is essential, because it is, as I said, more grey area, as I said earlier on, whereas the rest of tax is more black and white.
Thanks, Patrick. I'm conscious of time. We have covered some questions that we've been getting through the panel, but if anybody does have any final question, you know, please send it through now, because we have only got a few minutes left. In the few minutes, while we wait for any additional questions, in the few minutes we have remaining, what I would like to ask each panel member, so get prepared, is we've covered a lot of ground today. Of course, we haven't covered all the ground. It's always very difficult to cover everything in a forum like this. But perhaps if I start with you, Joel, any last tips, messages, key messages that you'd like to leave with the audience?
I think it's a reiteration that legal agreements are such an incredibly useful document when it comes to an audit, and it really makes a massive difference if you've got a very well documented legal agreement with respect to the audit itself and with respect to the risk you carry from various tax perspectives, whether it be you know, like we said, GST, it could be an extra charge or a CGT event, it could be customs duties, and the list can go on. Importantly, it's imperative to put the effort into that legal agreement as things change. And I guess you know, it's to state the obvious, but we've got a significant amount of change now. There's going to be restructuring within, you know, emergency restructuring within businesses right across the world, and they'll be happening quite often without actually interaction with the tax team. Hopefully they do interact with the tax team, but the business requirement is that now. So it's a real challenge to make sure that tax advisors and tax managers and CFOs stay very close to the business, understand these, and then link that back to not only your transfer pricing documentation and your policy, but also those legal agreements.
Thanks, Joel. Patrick, your tips?
I suppose from my perspective, it's almost a reiteration as well. I think it's very important that the head of tax or group tax manager in an in-house environment protects the CFO, protects directors and the business by putting the right agreements in place proactively. I say proactively because when a tax authority comes in to do a review, they're looking at maybe the last 4 years, and it might be 3 years ago. So for instance, the work I could do today proactively to put those agreements in place, I might not even work in the job I'm in today in 3 years' time, and someone else will benefit from that. So it's very important from a professionalism point of view, the job you're doing, that you get your legal agreements right, to get your transfer pricing policy right, to get your governance framework correct, and they all link in together. So I think it is a core element of your job in-house. And I think the last takeaway I have, it's not necessarily something the CFO or CEO will tell you to do, but it's something you should know intuitively as a tax professional from your training to do, and to take that approach and ensure it is completed.
Thanks, Patrick. Paul, before I come to you, there is just one additional question that I wanted to throw to the panel. Actually, I'm going to throw it to Joel, if that's okay, Joel. So Joel, the question is, when we talk about COVID-19 effects on multinationals, do we mean the roles of various subsidiaries have changed? Maybe you'd just like to expand just very briefly on what sort of COVID-19 effects we're talking about in this context.
Well, they can be many and varied, but I think you have to go through a step process to see how COVID will actually affect your transfer pricing. And firstly, you have to see whether there's been an actual change in the functions, assets, and risks of the particular entities, whether that be a subsidiary, limited risk distributorship, or a contractor, a toll manufacturer, or whatever it might be, a service provider, whatever it might be. So if that has changed, then you're looking at potentially recharacterizing your entity, and then carrying out a new comparable analysis to work out then what the appropriate transfer pricing should be. But if it hasn't changed, and you do remain the same characterization, then you can still have an effect from the change in the comparable data. So, for example, you might be an LRD with, let's just pick a number out of the air, say it's a 4% EBITDA sales ratio, which is nicely inside your interquartile range. Arguably, depending on what industry you're in, that might not be appropriate. We are seeing significant drops in EBITs of entities across the globe as a result of COVID. Unfortunately, we won't have that data for some time, because those comparables need to close their financials and then make them public. But there is definitely an effect there, and then managing that is the next challenge. And there's obviously a whole range of strategies in order to do that.
Yeah, and I think it's a good question, because I think it comes back to a lot of what we've talked about today in terms of substance over form, what the agreements say, who bears risk, etc. But it's also a very broad question, and I think it's a great answer in true transfer pricing advisor form. It depends. So, Paul, I'm going to give you the last say here, if I may, and just turn to you to ask what tips or key message would you like to leave with our participants today?
Thanks, Sarah. Yes, so really just two key messages. Number one is apply the legal entity perspective in terms of the arrangements, and it really goes back to Patrick's point about protecting the group as a whole and the individuals within it. In other words, this is a key protection for the directors of subsidiaries within the group, that they are able to clearly demonstrate what have they agreed to, does it make sense, and that it's an arrangement which they can properly approve. So that's applying that perspective is so critical. And it's not just a one-off arrangement. Things like cash pooling structures, extremely topical right now. You can't just leave them on a set and forget type basis. It needs to be reviewed on a very frequent basis in the current environment. Does it still make sense for an individual contributing entity to continue to contribute to a cash pooling arrangement? That's number one, the legal entity perspective. Number two is about simplicity in agreements. So my personal philosophy, our philosophy at LCN Legal, is that if you can't describe an intercompany transaction in 2 or 3 sentences, it probably doesn't make sense and it's probably wrong. And if you can't articulate the core proposition from a legal perspective in 10 or 15 pages at the outside, unless you've got really, really good reasons, for example, regulatory requirements, the agreement is probably wrong, it's not going to be read by anyone, and therefore the chances of it actually being followed are pretty much zero. So, cut to the essence of the arrangement, articulate it clearly but briefly.
Which means your legal advisor needs to very fundamentally understand the business, the functions, assets, risks, as well as the intercompany transactions that you are trying to determine what the legal agreement is documenting. And I think that's a really important point, Paul, because often I think perhaps there isn't great briefing of the lawyers in terms of crafting the agreement itself, which means that, what goes in comes out perhaps not as meaningfully as it needs to be as well. So I think a great point to finish on. So I'm conscious of time. We have covered quite a few questions. We've covered a lot of ground. So I'd like to draw the webinar to a close, and I'd like to say thank you to our panel today, Paul, Patrick and Joel. Thanks for sharing your insights and your experience, and we look forward to hosting our final webinar of the 4-part series with TP Minds, and that will be next Wednesday afternoon at the same time. And that topic will be in relation to financing. And so please, if anyone has an interest in financing and you want to hear from the Australian Taxation Office in relation to their views on financing arrangements with Australian multinationals, whether it be a subsidiary or Australian headquarters, please do register for that webinar. I think you'll find that very insightful, and certainly get a good feel for what the environment is like in Australia at the current time, where you have financing arrangements in place. So thank you very much, everyone, for joining. Thanks again to the panel, and we wish you a good day and a good evening. Goodbye.